you are ready to start investing your money to build passive income and to build generational wealth. And we all know that one of the best ways to start investing is by investing in the stock market. The only problem is that number one, you don't actually know what to invest in. And number two, you don't have an investment strategy. So what should you do? You should watch this video right now because I'm going to tell you exactly how to invest for beginners. Now, it's super important that you watch the entire video because I'm going to tell you the best investment strategies and exactly how to invest by my step-by-step guide. Now, guys, let me just say before we jump in that obviously I'm not an investment advisor and I'm relating my personal experience to you. So my friends, what actually is the stock market? The stock market is made up of a bunch of things called stock exchanges. A stock exchange is where people like you and me actually start buying and selling different types of things. There are mainly three types of things that are bought and sold on stock exchanges. Bonds, which are pretty conservative types of investments. There's stocks, which are pretty risky investments. And then finally, there's commodities. And commodities is a whole different picture. We're not even going to go into that today. If you're looking to make a lot of money, especially in the long term, the stock market should be one of the very first things that pops up into your mind. Specifically, on average, the stock market returns about 10% per year. That actually beats inflation. Since 1913, the average inflation has been 3.1%. That means you're winning. And number two, the stock market is often better than bonds. Bonds, which we spoke about before, are pretty conservative. They don't grow as fast or as much as stocks. Now, the number one reason why investors actually don't earn that much in the stock market is because they're not invested for the longest time. In fact, in order to make money, like actual money in the stock market, you need to be invested for the long term. It's just the way it works. The winners in the stock market are not so much active traders. They're the ones that are invested for the long term. And by long term, I mean 10 to 20 to 30, if not more years. If you invested $10,000 50 years ago, guess how much money you would have today? That would be over $380,000. Now, of course, we also have to focus on the downside. You gotta remember that the stock market is volatile, right? It has its ups and it has its downs, just like us humans, right? As long as you're invested in the long term, this really shouldn't make a difference though to you. And finally, one of my other favorite things and favorite reasons to invest in the stock market is earning passive income. It basically means while you're sleeping, your investment account is growing bigger and bigger and bigger. And that, my friend, is all through dividends. Dividends is when companies actually pay you, the stockholder, a very small, but they're still paying you a percent of their profits. Now, when you receive a dividend, you can either take that dividend as cash, or you can take that dividend and reinvest it in the stock itself. And that, my friends, is what I do. Basically, every time you reinvest dividends, your ownership share of that particular company grows. And the more you own of that company, the more dividends you get. The cycle is endless and it's good for you and your pocket. All right, let me give you an overview of the 5 steps to take to start investing in the stock market. Plus, I'm going to tell you the 2 best strategies that you can start now. The very first step in this process is selecting an investment platform. An investment platform is essentially any place that you can trade and buy stocks. The best investment platforms out there include Vanguard, Fidelity, Charles Schwab, and if you really want to have a simplified version, especially if you're a beginner, maybe you want to try out investment platforms like M1 Finance. Acorns is another one. Take a look at all of them first before you start opening an account. There are a couple of things that you want to pay attention to though. Number one is the management fee. Is there a cost based on how much money you have in that platform? Sometimes there is a cost, other times there's not. M1 Finance, for example, does not have a management fee, which means more money in your pocket. You also want to think about the type of account that you are about to open. At least in America, there are 2 different types of accounts. Number one is a tax-advantaged account, And number 2 is a non-tax advantaged account. The tax advantaged account is basically where you don't have to pay taxes on the gains. They give you some sort of advantage on your money, especially when it comes to the growth of your investment. The non-tax advantaged account is essentially an account like an individual account or a joint account. Even a trust account qualifies. They're accounts that grow in value, but you have to pay taxes in the year of receiving a dividend, for example, or you would have to pay taxes on any capital gains in the year of that distribution. Of course, you got to figure out your tax picture for non-tax advantaged accounts and tax advantaged accounts first before you start investing. From my experience, if you're an active trader, you probably want to invest in a tax advantaged account. The reason why is because when you buy and sell stocks and bonds, for example, at a profit or a loss, you don't have to pay taxes in the year of that trade. Now, of course, when you open your account on an investment platform, you also have to fund the account. Typically speaking, you can fund it in many different ways. Number 1, you simply write a check made out to you for that particular account. Number 2, you link the account to your bank account, and then you transfer funds electronically. The second step here is actually researching the types of stocks that you want to buy. You can sign up to the platform called Seeking Alpha, which is just a research platform, and you literally have access to some of the Wall Street pros, to other investment professionals, and to those that have CFAs, which are Chartered Financial Analysts, the absolute best designation you can get if you are investment professionals. Now, some things that I personally research when I look into stocks and bonds, for example, is number 1, the growth of the stock. How fast has this stock grown over the last couple of years? I also want to take a look at the value of a stock. Is the stock super overvalued compared to other stocks in the same industry? And finally, the third thing that I look at when I start buying stocks is the dividend. Typically, dividends are paid out on a monthly or on a quarterly basis. If you're growing older and you're looking at retirement at some point, you might want to get more dividend-paying stocks. If you're younger, though, you might want to not focus so much on dividend stocks and more so on growth stocks to build your portfolio, make it go up higher. Now, if I'm being totally honest about researching, I honestly love index fund investing. Basically, I take the best indices out there, like the S&P 500, which invests in the 500 best companies in the United States, and I put my money in that fund. I like index funds because they're passive, I don't really need to think twice, and they're also diversified because one fund can invest in hundreds, if not thousands of different companies. Now, I love what Warren Buffett says. Our favorite holding period is forever. Don't have the mindset of jumping into the stock market, buying it, and then boom, selling it the second it goes down. That's not how it's supposed to be. Step number 3 is actually figuring out how many shares do you want to buy. You can start investing as little as $5, if not less. All right, guys, number 4, let's actually dig into your investment strategy. Number 1, dollar cost averaging. And number 2, lump sum investing. Now, DCA is when you have a lump of money, but you decide to invest it incrementally. So for example, if you have $100 in your bank account, so you take $10 every week and you invest it in your predetermined fund, it's automatic. Then your $100 is fully invested in the stock market. That is DCA. Now, what is lump sum investing? Like you might imagine, lump sum investing is where you take the full $100 and boom, you plop it into your investment account. You invest it right away at the beginning and never think about it again. Lump sum investing outperforms the DCA strategy 75% of the time, regardless of asset allocation. So why doesn't everyone recommend lump sum investing? Actually, it's not the best if you are not someone who can stomach volatility. And like I said before, the stock market is filled with volatility. The dollar cost averaging strategy, the reason why I like it is because it gives you gradual exposure to the stock market, which means you have less stress and you can also avoid regret. The last thing that I love about the DCA strategy is that it's automated, meaning you literally set up the specifications that you you want in your account, how much money you want, when you want it to be invested, how often you want it to be invested, and the type of stock that you want it to be invested in. And then all you do is you sit back, you shake your hands off your work, and you never worry about your DCA strategy again. It's that simple. All right, step number 5, my friends, you're almost done, is literally being invested for the long term and being patient. Now, trust me, being an investor for almost 10 years now is not easy. In fact, there could be times where you wake up in the middle of the night, worried and stressed out about what's going on in the stock market. But please, especially if you're young and especially if you're making contributions to your investment portfolio, that shouldn't be a concern. The point is you're invested. You're adding money, especially when the markets are down. Remember, that is a perfect opportunity to make additions, to buy more, buy low, sell high. So let me give you an example. If you're fully invested in the stock market, you would make an average between 7 to 10%, right? That's what we talked about before. If you miss the one best day, your returns drop from 10% to 3.9%. That, my friends, is a 61% decrease in your money. Let me go a little bit worse. If you miss just the 5 best days of the market, your returns will drop from 10% to negative 6.3%. If your goal is to make money, then it's so important to remember this phrase right here. It's about time in the market, not timing the market. It's okay if you lose money right now or tomorrow or next year. It's totally normal. The point is you want to be in the market for the long term. In March and April of 2020, the stock market, specifically the S&P 500, had a massive drop, and a lot of investors were so worried. They were running around and screaming. They wanted to take their money out of the stock market. And you know what? I had people ask me, "Hey, Fiona, would you actually take your money out?" And I was like, whoa, stop right there. No, I am actually going to add money to the stock market. And you know what? I made over $30,000 in gains because of that decision. However, I do want to say that the number one way to generate large returns is if you start investing consistently and increasing your investments over the long term. This is why it's super important to increase your income earning potential with a side hustle. And that's why you should click on this link right here where I go over the best side hustles to help you make more money and get you wealthier.